All right. Good morning, everybody. It's Tuesday, 10 o'clock. So it's Tim and Tim. We're back again. What's up, Tim? Looks like you voted today, buddy.
I did vote. I went and voted straight something. I don't know what it was. It was just
I filled in the circles. I did too. I don't have my little sticker on, but the wife and I went and voted this morning. Thank God there was like no line there. But
no.
the worst, I don't know about you, but the worst feeling is I don't care what party you vote for, but man, when they're doing the campaigning or whatever, when you're trying to walk in the door, I'm like, geez, just let me do my thing. And, just stay out of my face.
Yeah, see that I didn't even run into that. There was nobody out there. There was like six people in the room where I went, and I don't live like out in the middle of nowhere, guys. Like there's
Yeah.
quite a big population around me. Um, but yeah, I was a little surprised at how little was there. I was also surprised at how little I knew about the candidates that were on the ballot.
I have to say the same thing, actually. Guilty.
Yeah. So
Anyways, yeah, I mean, it was a quick process. So if you guys haven't voted yet, please go out and vote because the only way that you're going to change anything that you don't like is by going out and vote and changing, things that are going on in your community. So go out and vote today. Like, there's no excuse for you not to. Yeah. So with that said, this week we're going to talk about depreciation. Hey, Brian Mitchell. Yeah, good connecting with you at MM5. So Tim and I were at Jake and Gino last weekend and met with a lot of people. Always really good seeing everybody and shaking hands, kissing babies, and just being out there and building connections and relationships with people doing what we do. It's a small world in the multifamily space, and get out there and know as many people as you can.
yeah, yeah, I agree. And Brian, good to see you, man. Always good to see guys that we know and meet new people as well. I think we met quite a few new people. And spent some quality time with some guys on our team.
Oh,
Um,
oh
yeah,
yeah, and it was Tim's birthday on Saturday, so we went out to dinner, and I got a photo of him blowing out his candles. I'm gonna show it. Here
oh
it is.
boy,
Let me see if I can get this up on the screen. There, look at that. There's our boy.
look at that. Yeah, and I'm completely red because they sang, and I hate that shit, folks.
Yep, yeah, we sang. This is a very, very high-end, nice steakhouse that we went to with one of the guys that we've built a relationship with that has sold us a couple properties. And yeah, it was funny that we were all singing in the middle of it, and the waiters got behind it. Man, this guy, remember his mustache? Oh
Oh
my
yeah,
goodness, he looked like he had some competition mustache stuff going on.
yeah, yeah. But you know what I do appreciate is I do appreciate when you confide in someone something you don't like, and then in good jest they pull that thread.
Oh, absolutely. Like
And I
you set yourself up for the softball
oh
toss, as you like to say.
yeah, and I completely appreciate that. Like I love a good jib every now and then, you know.
Yeah, yeah. Yeah. Well, good. All right. So, all right, we got like a little over 50 days left in the year, and we've had so many conversations with investors. And everyone seems to be scrambling a little bit because there's a little bit of misconception going on with bonus depreciation and cost segregations and how all of that stuff actually works. So, yesterday, Tim and I had a conversation with a guy, and he called me. He goes, Tim, I need you to help me out with this explanation because you just talk about it better. And I come from a finance and accounting background, so I'm not a CPA. Please don't quote me on anything that I have to say. I just understand how it works really well because it comes with my background. So, yeah, so this is the last year of 100% bonus depreciation. What does that mean? Bonus depreciation is on a 5-year phase out. So this year is the last year for 100% bonus depreciation. But don't worry, next year we get 80% of that number. And what does that mean? Ultimately, what that means is when you get a cost segregation done in year one, you're able to take all of the items that are past their useful life and you're able to push it into year one and take that write off in year one. Well, the last couple of years, we've been able to take 100% of that year one write off. Next year, we're only going to be able to take 80% of that write off, and then it's going to be spread out throughout the cost segregation schedule or your depreciation schedule. Why is it important to get a cost segregation done? It's important to get a cost segregation done because what it does is it takes every single thing except for the land, every single thing in your apartment complex, and it puts it into a life cycle schedule, right? So it says, if I think carpets go into a 5-year schedule, for example. I don't know exactly where they go, but that's where I would assume. And if you have a carpet, a brand new carpet that goes in and it's on a 5-year cycle, that would say that every year, $20 of that $100 would depreciate, right? Well, if you're buying a property that you're doing these value add deals in and you're replacing the carpets in 100% of the building, well, what they do is they take the percentage of carpets throughout the whole building and they apply that against your purchase price. And then they say, okay, well, if we're ripping out all of these carpets, this is the value that we paid for the carpets going into the property. And we say, hey, well, those are no longer useful. They're past their useful life. We're going to write them all off year one. And then what we're doing is we're going to reinstall new carpets, and the invoice for those new carpets are then put into a 5-year bucket and depreciated over a 5-year schedule. So it's moving everything around in the cost segregation study in the depreciation schedule in order to put it into what the IRS calls useful life, because after something's past its useful life, they intend for you to throw it away and get rid of it and put new stuff in. Does that make sense? And hopefully, I can get a couple comments of people that are watching the show currently. But Tim, you got anything to add on to that?
Yeah, it makes sense to me. I like I said, you or like you said, you explain it way better than I do. It's like I get the concept, I understand it. I always have trouble putting my finger on like what it's going to translate to in terms of pure dollars, right?
Mhm.
Which you always do a much better job of figuring out for me. So is there any way like we could talk about like let's say you buy something at a certain price and you plan to put a certain amount of capex into it in 2022, what that might translate to? Is there any way to do that kind of thing? Just a
I'm
theoretical.
not. I wish I had like a better depth of knowledge to be able to answer that question more specifically. But there's a couple of things that I'll say here that are important that I know that need to be done. Is that when you're getting a cost segregation done, they're only going to look at the cost of the capex that had been actually deployed into the deal. So if you buy a deal today and you got $1 million capex budget, you're not going to be able to include that $1 million capex budget into your cost segregation in the first year because it's quite impossible for you to deploy $1 million over the next 50 days in renovations at a property you just took over, right? And now, I mean, there's probably somebody out there that's going to challenge me on that, but I would say 99% of the time, like you might be able to deploy a tenth or a quarter of that in 6 weeks or something like that. But I really find it hard pressed for you to be able to go and complete $1 million rehab budget in 50 days. Um, so what I would say is in terms of cost segregations and what we've seen with our investors and the cost segregations we've done is that on an invested dollar basis, our investors typically see an average of around 35% of depreciation in year one when there's 100% bonus depreciation, right? So what that means is like if you invest $100,000, you can likely expect to see a $35,000 year one loss or depreciation allocation from your investment dollars, right?
I'm writing this down.
I know. I see you writing it down. I'm wondering what you could be writing down.
Yeah,
Here we
I'm
go.
writing that down.
Dennis says, "Is that only good if you're going to hold long term?" No, even if you only if you think about it, there's quite a bit of stuff in a cost segregation study that goes into a 5-year bucket. So if you're able to move everything into year one, take that right off, then do all of your renovations and put all of those new items into a 5-year bucket, the first 5 years of depreciation that you're going to realize are going to be significantly higher than all of the year than the years after because it's put into that new schedule of depreciation. So it's not something that if you hold a property for a year, you should do it. You should always do a cost segregation
Yeah.
because there's also tax benefits of how the taxes are calculated on the back end, right? So if you're getting a $35,000 depreciation, that reduces your taxable basis on what you pay, right, for taxes, right? Because it reduces your capital gains and reduces your tax liability. It is not a one for one dollar write off. If you get $35,000 of depreciation and you owe $35,000 in taxes, it doesn't mean that you owe $0 in taxes now. It just reduces your basis that $35,000 was calculated on, which would be roughly about $100,000, right? So it would bring your basis from 100 down to 70, and then your taxes would be calculated on the 70,000, not the 100, right? So there's a little bit of misconception there in the application of how that actually works. But furthermore, yeah, so Kenny, he's actually talking about where I was going was recapture. So when you take that depreciation, right, it reduces your tax basis, it reduces the amount of taxes that are calculated. And then on the depreciation recapture, don't quote me on this percentage, I'm not a CPA, but my understanding of the recapture taxes are that of the depreciation amount or the net losses that you took, you only pay recapture taxes on 25% of that basis, right? So the $35,000 that you took as a write-off, well, when you go for recapture, right, depreciation recapture, you only pay taxes on 25% of that 35,000. So your net is still going to be better, right? At the end of the day, your net is still better because you're not paying 100% of that 35,000, then you're just literally kicking the can down the road. There's still a benefit to doing the cost segregations and getting depreciation and write-offs in order to reduce your taxable income.
Yeah. So Tim, like when in that example where you went from 100,000 down to 70,000.
Yeah, reducing
So
your tax basis. It's
yeah,
important to label those things correctly because if you don't, it can easily get lost.
so does that have any impact on which tax bracket you're paying in? Let's say that that is your income for the year, right? Um, does it lower that as well?
So taxes are calculated in brackets, right? So like I don't know what the brackets are, but say for example, um, you're taxed at 25% or 10% for the first from 10,000 to 70,000, you're taxed at 10%, right? So then you would take that $60,000 times 10%, you owe $6,000 in taxes, right? But say for example, from 70,000 to 150,000, you're taxed at 25%. So if you reduce your taxable basis from 100 to 70,000, then that $30,000 reduction is not taxed at 25% in that bucket, right? Because it's a bracket. So the first 60,000 or first 70,000 is taxed. Well, so 0 to 10,000 is 0%. 10,000 to 70,000 would be 10%. So then you owe $6,000, right? Because it's $60,000 of taxable income. And then if you made that 100,000 and it was taxed at 25%, then you would owe 25% of the 30,000, or what's that number? 10, six, like what's that number? Like $7,000 or something?
20% of 35,000?
25% of 35,000.
Oh,
Roughly. So 10% would be 3,500, 20% would be 7,000 plus another 5%. Call it 8 grand, right? So your total taxable liability would be the 6,000 plus the 8,000, which is 13,000, right? I'm terrible at math in my head, guys. Math adding and subtracting in my head is awful.
yeah.
So now you have a total tax liability of what, $13,000. Well, if you get into a different tax bracket, meaning you're just eliminating that money that's taxed at a higher bracket, yes, you're going to ultimately save money. Now, all of those numbers are arbitrary, completely made up for example purposes only.
Yeah. So here's a good question, and this is pretty easy to answer actually. Does it work for single family or mobile home parks?
Absolutely.
Sure.
Yeah.
Yeah, absolutely.
I've seen that there's a rule of thumb that if you own a property that's over $250,000, then you should do a cost segregation study on it because the benefits are going to outweigh the cost of getting the study done.
Oh, what a softball. Look at that.
How much does a typical cost segregation study cost? Oh, good question. So what we've been paying on our apartment complex is ranging from 24 units up to 110. Our average cost is about $6,000, something like that, 5 or
Yeah.
6,000. I know I own a 24 unit in Florence, and I got the cost segregation on that 24 unit is 4 grand, but it's also $910,000 purchase price. So I would hope that if you're doing it on a single family, that can be done just like a keyboard cost segregation. They don't have to come out and actually do a study, like a physical inspection or study, that it would be less than $2,000, for a home that size. But obviously, there's tons of people you could go out to and just ask for quotes. They give you free estimates anywhere, right? So go to any of the cost segregation study guys that you know. And if you need a recommendation, shoot me a message or Tim Vest a message and we'll connect you with one.
Yep. So what if you've owned it
Oh,
for a few
oh, really
years?
good question, Bob.
Yeah.
So glad to see you, Bob. Um, really good question. Yes, you can absolutely go back because it's funny. I had this conversation with my CPA a while back. Was that when you have a property and you're doing straight line depreciation, right? So 27 and a half years, you take the purchase price less the land value divided by 27 and a half. That's your straight line depreciation on a normal depreciation schedule. That technically, in the eyes of the IRS, is an improper way to depreciate a building. So there's a form. I couldn't tell you what the form is. There's a form. Ask your CPA. They'll know what you're talking about. There's a form that you would have to submit to the IRS, and it's a checkbox that says you're going from an improper to a proper tax depreciation schedule. And it is actually encouraged that you go do a cost segregation study on a property that you owned. And remember, the whole recapture tax thing that we just talked about is still going to net you less taxes paid over the life of the deal. So I've seen there's one person that floats around on Facebook that posts all the time. People that have never have gotten a cost segregation study done, and they get it done right before they sell a property, they're still going to end up netting more money in their pocket because of the recapture basis, of how all of that stuff works.
Yeah. So here's a question for you, Tim. Um, let's say you buy a property this week, second week in November, right?
Hmm.
Um, and you're going to do some capex on it, and like you said, you're probably not going to be able to deploy a million over the next 6 weeks, right?
Uh-huh.
Is it worth doing? Do you think it's worth doing a cost segregation this year on
Absolutely.
it, or
Yeah,
yeah,
I mean, legally you should because the date you put the property in service, it automatically starts the depreciation clock, right? And if you do the study and you bought the property for just now, right? You're still going to net benefit year 1 more than you would have in year 2. And I've been through this before where it's not been depreciated correctly. It's technically illegal not to depreciate your property correctly. The IRS classifies it as illegal, but they're not going to come after and chase you for not paying more, for paying more
for
in
paying
taxes
more?
than you should. Yeah, because the cost segregation does the opposite.
Yeah. So, and that guys, that was a little bit of a softball question. We've actually run into that situation before.
Mhm.
Um, but yeah, I mean, no matter when you close, you know, run that segregation study, cost segregation study,
Absolutely.
and then two, like this time of year, we're starting to get to the time of year where they have a much better picture, right, of what their
Yeah.
financial situation looks like for the year. So people are looking for depreciation right now.
Yeah, there's a
We've had a
lot
number.
a lot of people are doing their Q4 meetings with their CPA and tax planners.
Yeah, and so there's a lot of folks out there right now looking for depreciation. So, be aware of that as you're moving forward. If you're closing on something in the next 5 to 6 weeks, be aware that that depreciation will be there for you to capitalize on, right? So, get educated on this if you haven't already. If this doesn't make any sense to you, definitely go out there and talk to somebody about it. Um, like Tim said, he's fairly knowledgeable on this, but even as much knowledge as he has on it, you probably should go talk to somebody like I don't know, uh, like a Yona about it.
Mhm. Mhm.
So
Yeah, no, I understand it enough to be dangerous, right? And that's kind of that's kind of the point of everything, right? Like I don't need to know how to do it, but I have to understand how it works. And this is one of the things that I've really honed in on that I understand how it works. Insurance is the other one because I did come from like an insurance accounting background, so like insurance is a little easier for me to understand and to really go deep into the insurance policies and tax benefits and all that kind of stuff. But like lending, I know Tim, you do a little bit more of the lending side of things, and you're a little bit more comfortable with it and go into it a little deeper. But yeah, I mean, you don't need to know everything, but you got to know enough to be dangerous, and you got to know how to apply it to your own situation. I mean, you're paying people to do tax returns for you and tax planning and all that stuff, but they aren't God, right? They're humans too. They miss stuff. They might not forget. They might not remember everything. And the more questions that you're able to intelligently ask, it just creates conversation of how can we do this differently, or how can we use the tools available to make a better benefit, right?
Right.
And you got to ask that question to the right audience, and the audience would be who's ever the professional in that field doing the cost segregation study, or your insurance broker, or your whatever, right? There's a whole lot of different scenarios out there. I'm just trying to illustrate a point.
Yeah, and understanding it to a certain point will also help you be, for you guys on here that are operators, it'll also help you be a better operator.
Hmm.
Because
Yeah.
you'll start to understand, I'm a little bit more of a long-term guy. I like to hold things long term, but if you're an operator, it'll help you understand when maybe you need to start looking at disposing of an asset, because this does
Hmm.
come into play to that. Or it will help you understand when you need to go find a new asset, right? Either way. Because that's one of the things that you see is, guys that are doing this, they're constantly looking for deal flow, partially because they're constantly needing to find
Yeah.
depreciation. um,
Yeah,
so
that kind of lines up with what Kenny's question back here was. I was kind of waiting for it to kind of come up in the conversation a little better to talk about it. But yes, how does a cost segregation and depreciation affect a 1031 exchange? So, to my knowledge, that when you do a 1031 exchange, you have to use your qualified intermediary, and your qualified intermediary is recording your net gains and your net losses that have been written off for that asset, right? When you're doing a 1031 exchange, you're taking those losses that are attached to that asset, and you're saying, I'm not going to pay those, the recapture taxes now on these gains. I'm going to attach it to the next property, but this information is never lost, right? So like there's a process that happens there that I've never been involved in. I've never completed a 1031 exchange because I have enough depreciation to just offset gains that I have. But that's my understanding of how the 1031 exchange works in terms of depreciation and how it's kind of recorded and scheduled. And you can continually kick that can down the road. Like, if you've owned property and you 1031'd it 5 times, and, unless something's changed, as far as I'm aware, that when you die and you pass the asset on to your heirs, the tax depreciation recapture goes away or is eliminated, and whoever is like inheriting the property inherits it at a new cost basis, and then a new depreciation schedule can start from there. So
yeah,
there's really good tax benefits to doing a 1031 exchange and continually rotating assets and using that depreciation to offset your gains, and then passing it down to your children and all that stuff.
yeah, and always be looking at these, right? Like always have a conversation, and I would even say before you just blindly decide to do a 1031 exchange. Um, there's there's good and bad, right? Go talk to your CPA. Let them know your
Mm.
scenario, because there are times when depreciation can remove the need for a 1031 altogether and just free that capital for you, and then
Yep.
you're not tied into doing a 1031 exchange.
Yep.
Um, so always have that conversation. Can you get enough depreciation from something somewhere that it can basically take care of the penalties that you would pay by not doing a 1031 exchange. So always be having those conversations.
Yeah, I went through that. I sold that condo, the first property I ever bought, I sold, and my intention was to do a 1031 exchange. My CPA is like, no, don't. Like, you don't need to do that. There was like some threshold limit, and it was below that limit, so I didn't have to pay taxes on it anyways. So he's like, I just saved you the headache of having to do a 1031, and you wouldn't have owed any taxes anyways. And on top of that, you have so much depreciation that you're never going to be able to use it all. So you should use it when you start selling these assets in order to deploy that depreciation.
Right. Right.
Because remember, the depreciation recapture still nets less taxes paid than if I, didn't do the depreciation, didn't do the recapture and all this other kind of stuff.
Yeah. So lots of all this being said, guys, like if your head's spinning like mine is right now, all this being said, get yourself a good CPA.
Yeah, absolutely, man. They're worth
That
their weight
way
in gold.
that way you can just go here, tell me what
Mhm.
to do. Um,
Yeah, I mean, but still, like, I have educated conversations with my CPA because we talk about these things. I'm aware of
right.
them. I don't know how they're done, but I know how they affect me, right? And that's ultimately like as an entrepreneur or CEO or president of your company, like that's the level of information you need to be able to do is have a conversation. Um, Belinda, how far back can you go? You can go back. I don't think that there's any limit on how far you can go back. Um, the only thing I would say is that if you've owned a property for 27 and a half years and it's been fully depreciated, then there's probably no benefit in going back and reallocating a depreciation schedule. That's the only scenario I can think of. If anybody out there can think of a different scenario where it doesn't make sense to do a cost segregation, but that's the only one I can think, because at that point in time, your asset is net zero on the balance sheet, except for the cost of the land, because you fully depreciated the full asset. You have no more depreciation. At that point, you absolutely want to sell it or 1031 into the next property so you can restart that, that whole process of depreciation and getting the tax benefits.
Hey, and Kenny, thank you. I would love to take credit for this, but I'll have to give it all to my man across the virtual table here. This is all Vitaly and exactly why I pulled him into a conversation as recently as last night, guys.
Yeah, yeah. And Kenny, I mean, I love doing this kind of stuff and talking about this stuff. You should check out our coaching group. And, we go into this kind of level of detail on a whole lot of different things. So, yeah. All right. Well, this has been really fun. I really like talking about this stuff because it's relevant, right? God, I got like an eyelash or something in my eye. It's driving me nuts right now.
Hey, and by the way, the fact that he finds this fun should tell you everything.
So what?
I said the fact that you find this fun should tell you everything. This
Oh,
guy loves.
man, I love talking about money. I love talking about wealth. I love talking about how to save money and taxes and how to like benefit people because like, I like to, Tim Broth's told me this once or I've heard him talk about it on his podcast and things like that all the time. But he's like, wealth's like sunshine. You and I can both go outside and get a tan and it's not going to affect either one. Like there's so much sun out there. Everyone can get a tan. Same thing with wealth, right? So we just collectively come together and we help each other learn how to use tools and things that are accessible to us in order to benefit each other.
Yeah. Man, that reminds me, I've read something this weekend, Tim. It's such a great statement. It's like, guys, like we're not in competition with each other, right? And I'm not going to get on a soapbox here, so please forgive me, but we're not in competition. There is absolutely plenty out there. Let's all work together and get this stuff done, guys.
Numbers nerds. Yeah.
That one. Oh, wait a minute. That one. I
Yeah.
don't know which side of the camera you guys are seeing. So,
Oh yeah. It's the opposite for me too.
there you go.
Yeah. Well, hey guys, really appreciate the time today. If you want to come spend some time with us and really pick our brains and really build a relationship with us and learn how to think how we do and learn a thing or two from us as well as some other people in the room. I invite you all to come to our Porsche event. It's race cars and real estate, November 18th and 19th. It's only 10 days away. We're going to have a very small room of only 20 people. We're going to be talking about anything and everything under the sun and driving Porsche 911s on the racetrack with an instructor. So come have some fun. Should be like a bucket list item for a lot of people. I know so many people love race cars and they love, high-end sports cars. And how many times you actually get the opportunity to talk about real estate, to talk about business, to use this as a business write-off because it's it's an expense for your business and make a memorable event that I don't want to say never going to be able to experience again, but like, something that's going to make you excited, like, gives you like some pizzazz, to go after and get fired up to go after your goals for the end of this year and early next year.
Yeah, I mean, I love what this guy said. I want to race some cars. I do too. That's part of the reason we're doing it there.
That's right.
I know Vitaly does, but guys, seriously, like we're headed into 2023. Sam Silverman's going to be there. Mike Ely's going to be there. Set yourself up for 2023, guys. Like get in front of guys that know how to raise, that are raising. Get in front of guys like Vitaly who knows how to talk about depreciation as we're heading into the next year. Like this is a really, really good time to be educating yourself and getting in front of some folks as you're moving into 2023. Like really, really good time for this.
Yeah, and I say it all the time. Like I don't pretend to know everything, but I create rooms of people that do know more than me so that we can collectively have conversations and learn how to benefit from each other. So, if that sounds fun to you, come to our race car event. I'd love to meet you. I'd love to hang out with you for a weekend. I can't tell you how many people have reached out on social media platforms and ask for coffee or virtual coffee or whatever. Like this is your chance. Come hang out with us for a whole weekend, build some relationships, learn from people that are raising tons of money. Mike Ely's been through, 2008, 2009, 2010 recession, and that's where he made the majority of his wealth. So I brought him in because I want to talk to him about how do I capitalize on that coming up over the next 24 months. So get in the room with people that have been there, done that, and learn from them and grow your skill sets and figure out how you can implement some change in your life and in your business in order to benefit yourself coming into next year. So
Yeah. Yeah.
cool.
Absolutely. Well said.
All right, guys. I hope to see you soon. If not, we will see you next Tuesday. Peace.